Symposium.org. I'd like to thank the organizations and individuals who've helped make all of our programming possible. Our presenting sponsors are the Town of Vail and the Frechette Family Foundation. Our event sponsors are the Vail Daily, Vail Resorts Epic Promise, and the Antlers at Vail. Our virtual programs are sponsored by Alpine Bank, and Cindy Ingalls has underwritten the summer season. Tonight's program is underwritten by Sandy and Stephen Bell and Mimi and Keith Prockross. Donors at every level make our programming possible. Thank you. Our next program takes place at the Eagle River Presbyterian Church this Thursday, September 22nd. It's called Giant Steps, Stories from Space and the Future of Cosmic Exploration. In this special program, Laura Shepard Churchley, daughter of Alan Shepard, America's first astronaut and only astronaut to hit a golf ball on the moon, will join in conversation with Major General Roy D. Bridges Jr., who piloted the Space Shuttle Challenger on the 8-day Space Lab 2 mission. Together, they will discuss her recent experiences aboard the New Shepard Blue Origin suborbital launch vehicle named after her dad, and they'll discuss the future of civilians in space and why space exploration is as important or more important than ever. And next week, in collaboration with the Vail Alliance for Purposeful Living, we have 2 in-person events. On the 27th, Unlocking Your Purpose at Any Age with Richard Leiter and Chip Conley. And on Wednesday, the 28th, for those who want to take a deeper dive, the questions you should be asking yourself to live purposefully. Tonight, we turn our attention to inflation in America. We have a panel of experts to discuss this important and timely topic. Our moderator is Richard Bard, the founder and chief executive officer of Bard Capital Group, LLC, a middle market private equity firm with a diversified portfolio. He has been involved in the acquisition and operation of several private and publicly traded businesses over the past 30 years. He previously served as chairman of the Federal Reserve Bank of Kansas City, and he serves as the key moderator for the Vail Symposium Financial Series. Again, a reminder to put your questions in the Q&A, not the chat. And now please welcome Richard Bard, who will introduce our esteemed panelists.
Thank you, Chris. Welcome, everybody. Welcome back. Many of us who follow the financial series for the Vail Symposium, we've had some wonderful events. I think tonight will be one that stands out among them, in part because we've got amazing topics to talk about. The economy is on all of our minds, and you can't turn the TV on or be at a dinner conversation without talking about what's going on in our economy and what's going on with inflation and costs and supply chain and all these new terms we're learning about. So tonight we have an impressive panel of experts. I think it's going to be fun for all of us to talk to them, including me. It's going to be a quick hour. The format will be a bit like a fireside chat, and except you're going to have to imagine the fireside. So we'll start off with a Q&A among us and go through a series of interesting topics, hopefully. And then as quickly as we can, actually, we'll open it up to the audience, because I think the enriching part about tonight will be your ability to ask these experts about the economy and about inflation, about the Fed, and all the different topics that we're going to cover tonight. So I think it's going to be fun, and we'll have plenty of time for audience questions. So, but prepare one question, not 2 or 3, and we'll have some fun doing that. Let me start by introducing our panelists. Lisa Shallot is the Chief Investment Officer of Morgan Stanley Wealth Management, which is one of the largest financial advisory and asset management companies in the world, according to their webpage, which must be true. We help people, we help businesses, institutions build, preserve, and manage wealth so they can pursue their financial goals. I happen to know several people at Morgan Stanley Wealth Management, and it's a great organization, and Lisa is amazingly revered. Our second panelist I'll mention is David Wessel, who is the director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institute, which is a nonprofit public policy organization based in Washington. And its mission is to conduct in-depth research that leads to new ideas for solving problems facing society at the national and global level. Norbert Michel is the Vice President Director at the Cato Institute for Monetary and Financial Alternatives, where he specializes in issues pertaining to financial markets and monetary policy. So we have some pretty smart people, some people that study financial markets, monetary and fiscal policy. And so let's have at it. So I'll start with Lisa. So Lisa, they say that recession is when your neighbor loses his or her job, and it's a depression when you lose yours. I think there's a debate whether we're in a recession. I assume we're not in a depression, but let's start off by talking about this whole debate over what this is called. Are we in recession? Are we not? Is it coming? How should we think about that?
So, I know that a lot of folks, got confused earlier in the year because of their use and reliance on, government data, which suggested that based on the GDP figures reported for first quarter and second quarter of this year, which showed absolute contraction, that we were in a technical recession, which is defined by two consecutive quarters of contraction in growth. We actually rejected that notion. We don't think that the U.S. economy is in a recession now, nor do we think that the U.S. economy is going to enter a recession in the next 12 months. And the fundamental reason really has to do with contextualizing where growth was coming from and why it was that growth was contracting in the first two quarters of this year, from what level. And so what we have to remember for context is coming out of the pandemic during, the calendar year 2021, the combination of this V-shaped recovery that was fueled by unprecedented and record stimulus, literally the equivalent of $9 trillion or 45% of annual GDP, was really producing extraordinary growth in our economy at the same time that we had inflation. And so the nominal growth, the real growth plus inflation as we exited 2021 was well into the double digits. Now, just to, contextualize that, for lay people, on the average year, real growth in the U.S. economy is somewhere around 2 to 3%. And as we know, inflation for the last 13 years has been 1.7%, such that nominal growth has been, somewhere between 3.5 and 4.5. So we were growing at double-digit rates. As we think about that deceleration in growth, there's a couple of factors, in that dynamic. One is we're moving from a consumption mix that was very heavily skewed in the first 2 years of the pandemic towards manufactured goods consumption. And that was because we were avoiding human contact. And so services, right, like travel, like leisure, like dining out, like entertainment, like sports events had essentially gone to zero while we were at home, ordering things from Amazon. We're unwinding that, and some of that is clearing. And so, as that occurs, as we reopen and as services rebalance, we think that this mix shift is helping us sustain momentum. The other two factors that we think prevent the U.S. economy from moving into recession over the next 12 months are that we view the COVID pandemic as a once in a century or once in a generation shock to both the labor market and the capital investment and capital spending market. And as a result, we believe that tight labor, as long as people have jobs, and they really do have jobs, we're not going to have a recession. And as long as companies have cash and are spending and investing that cash, we're not going to have a recession. And the reason that COVID did that, quite simply, is we had this episode where systematically, in a very tight window, virtually every single business had to rethink their business model and make it a contactless business model. And that has spurred unbelievable investment in digitization of all kinds of business models, from whether we're talking about, medicine becoming telemedicine, or we're talking about the fundamental basis of work, which is in the process of transitioning to a long run hybrid model. But all of these systems have been shocked in a way that we think is actually supportive of growth. And we do think that this economy avoids a recession, at least over the next 12 months, even with the Fed tightening and attempting to fight inflation.
Well, that's an interesting position. So when will you know that we're heading to a recession? Is there some data that you'll look at?
Well, so absolutely. I mean, for us, recession is going to be precipitated by a disintegration of those two factors that we're looking at for support. So one, the deterioration in the labor market. Right now, we've seen unemployment move from 3.5% to 3.7%. If we were to get up towards, 4.5% unemployment, we would start to get concerned, that growth was actually at a point of contraction. The second thing is we would want to see a much more durable collapse in capital spending and durable goods. And one of the things that has been interesting is that despite the fact that mortgage rates are, closing in on, potentially as much as 7% if Fed funds gets to 4%, which we think it will, durable goods spending has held up. We're still seeing inflation, in used vehicles. We're still seeing inflation of rents. That means demand is there. And so we're looking at those two items, durable goods spending and jobs.
So, David, do you have some thoughts on this?
I really hope Lisa's right. And I pretty much agree with her depiction of the past. I'm a little less optimistic about the future if I look ahead 12 to 18 months. She is absolutely right. The labor market is impressively strong, and the economy does seem to be shaking off a really unusual COVID period where we literally put the economy into a medically induced coma. And of course, there were a lot of dislocations. I think there are three things that I would take as warning signs. One is something's ailing the stock market. The stock market has come down a lot. So that suggests there's somewhat less bullishness among investors, although I would be the last person to suggest that the stock market can predict when we're going to have a recession. Secondly, the rest of the world is slowing, and that'll reduce some of our demand. That has some upsides on inflation because it's already beginning to reduce commodity prices, and that should make the Fed relax a little bit. I think the thing I worry a little bit more than Lisa suggested is I think the Fed is so determined to bring down inflation and so determined to not risk letting inflation get embedded that they're more likely to do too much than too little. And that leads me to believe that in their efforts to slow the economy, because of course we know one reason we have inflation is that we have too much demand. It's growing faster than the capacity of the economy to supply it. Some of the things that are causing inflation are one-offs, not having enough chips to make cars and problems generated by the Russian invasion of Ukraine. But some of it is the old-fashioned form of too much demand and not enough capacity to supply it. I worry that the Fed will keep raising rates until they push the economy so close to recession that the slightest bit of bad luck would push us under. I don't think it'll have to be a bad recession. I think the Fed has caught up. The Fed was behind the curve. They've caught up. They've raised rates a lot. They're going to raise them a lot again tomorrow. They're talking tough on inflation because they want to convince us all that they're not going to let inflation get embedded in the psychology of workers and consumers and businesses and markets.
Well, so there was a recent survey I saw that 50% of employers expect job cuts in the next year. But how does that fit into, Lisa, your thinking and yours, David? I mean, we're hearing about layoffs at FedEx. We're hearing about Amazon stopping their expansion. On and on
let's be clear. The Federal Reserve wants to slow the economy. The Federal Reserve does not believe we can continue to add 300,000 jobs a month as we did in August.
Right.
There is no doubt that the employers are going to hire less readily, and some employers are going to lay off. Much has been made about this index that the Bureau of Labor Statistics posts, that we have 2 vacancies for every unemployed person. The Fed is hoping that we can reduce the number of vacancies, have a limited amount of layoffs, but not so much that we end up pushing the economy into recession. So does the Fed think that they're going to keep unemployment at 3.7%? No, I don't think so. The question is, will we get to Lisa's threshold if the unemployment rate raises another, say, 0.5 percentage point to like another, like to say 4.5 or so, that'll be a sign we're going into recession. We don't really know yet. Is there a chance we could have this soft landing where we just have some layoffs and some businesses tighten their belts and we adjust, inflation comes down relatively quickly and we avoid a recession? Of course. Is that a certainty? No. My guess 60-40 we have a recession or not, but I don't manage money like Lisa does, so I listen closely to people who actually have money on the table.
Yeah, Norbert, what's your thoughts? Yeah, unmute.
Well, yeah, no, and I mean, in terms of past, I have to agree completely with Lisa, and I guess by default, David as well, agreeing with Lisa. I mean, this is an unprecedented set of circumstances, self-induced, if you will, and there's just nothing like this in the historical record, both in the downfall and in the snap back. And so, of course, you're going to have massive dislocations and problems, and they're not going to look like anything in the past. Everybody wants to hang the 2-quarter recession thing out there, but the truth is that's only happened 5 times in the post-war period, 2 quarterly declines. So that's, and look, the NBER will tell you, anyone who looks it up will tell you there is no fixed definition of a recession. So, I mean, I think, it's hard because everybody wants to label it something and name it something, but things are not great. But why would they be, given what we just did and what we went through? It's going to take some time to clear out. I think also agree with David. The biggest fear is that the Fed does too much to slow things down too much. Personally, I know this is sort of anachronistic, but if it were me, I would err on the side of having a little too much inflation for a little too long. Again, given what we went through. Over time, income does tend to keep up with inflation. And that doesn't mean it's painless, but it's a heck of a lot less painful than a massive deflationary depression. And it seems to me that it would be rather strange, terrible idea to induce something like that, for the sake of getting the rate of inflation back to something that we want on a normal basis when we're not on a normal basis.
Yeah, I would agree with you. So having been at the Fed, I think the tendency will be to overshoot. And it's just the way it is. And part of the problem is that their tools take time to be implemented. So the impact of these rate increases is anywhere from probably 9 months or longer. So, dial forward 9 months from now, and regardless of what's going on in the economy, the impact of these rate changes is going to be hitting the economy. So it's going to be an interesting time, but I would agree with all of you. I think it doesn't really matter what we call it. It was
right.
So the semantics don't really matter. What's going on in the average person's life? It's a very unusual time. I mean, people have jobs. I mean, I'm an employer, so I can tell you it's hard to find workers. I own a restaurant. I own a trucking company. I mean, try and find a CDL driver. They're at 65 hours an hour, they don't want to talk to you. So it's a very unusual time. And I think the definitions, to some degree, they don't matter. But at some point, when you start seeing a lot of layoffs, a lot of hiring freezes, and employers are starting to do that, and it's going to have some impact, which I guess from a Fed standpoint is a positive reaction to what they're doing. Because when I was at the Fed 15, 20 years ago, I mean, as the Greenspan Fed, I mean, it didn't matter. We raised rates, and there was overnight borrowings from the Fed were about $200 million. It just, there really was no real impact. It was all psychological. I thought that was quite interesting, and it's still the case. It's the headline. So we'll see how that goes. Let's move on to the topic of inflation. Actually, I'll let you start, Norbert. You're front and center. What's caused this? Has it been excess demand, as Lisa talked about, or is it more lack of supply?
Well, it's both. It is. I mean, if you go back to the original cause, I'm on the supply side, and if you want to go to the more prolonged cause, I'm more on the demand side. But you've got both a supply shock problem going in, and partly due to all the fiscal stimulus that we've had, and just the general snap back that happened so quickly. You've got a surge in demand against a constrained supply, and so you do have both. And then as you go closer and closer to now, you've got a nominal increase in GDP that's way above trend. So you've got to look at the demand side. That's just there. There's no way around that one. And when you start to kind of get into the weeds, you can't get hung up on things like gas prices are too high. That means we have inflation. However, there were, for most of this period in the last couple of years, only a handful of components of the consumer products that were driving the broader index increases. So again, long way of saying both supply and demand problems. And why that's important now, though, I think all those supply problems have not cleared. The more the Fed does, the worse it's going to be without much of a benefit, because monetary policy is not very helpful at all for supply shocks. And it's crazy to say that that we don't have any right now. So again, that's one of my worry about the Fed side.
David, what do you think about that? Are we ever going to get back to pre-pandemic levels of prices?
Yes. Look, I think the big difference between the Greenspan years and what you spoke were we didn't have inflation. Consumer prices rose 8.3% over the past 12 months. Even excluding volatile food and energy prices, they were 6.3% over the last 12 months. So we have a lot of inflation. And what the Fed is saying is we want to make sure that you understand we're going to bring down inflation because we don't want you to expect this kind of inflation. And so that's why I think they're going to be aggressive. There's a question, someone in the Q&A asks, what about, aren't companies taking advantage of this to jack up prices? And is that one of the causes of inflation? And I think that what I say to that is, well, companies didn't suddenly get greedy. Companies have always been interested in raising prices when they can. Are they taking advantage of the fact that there's very strong demand for their products to raise them? Absolutely. And maybe one way we can get out of this without too much economic pain on the part of workers and consumers is if margins, profit margins, which have been fairly substantial, contract a little bit. That is, some of the increased costs are absorbed by companies. And I suspect that's one reason why the stock market is beginning to weaken a little bit, is people are saying, well, the companies aren't going to be able to make quite so much money. But I think that's maybe amplifying the price increases, but it's not the cause. And I think to Norbert's point, of course, the Fed can't do very much about supply side problems. There's nothing that Jay Powell and his colleagues can do to fix the problem that we don't have enough chips to put in cars, or the price of oil is up because of what's going on in Ukraine. But I think that the way the Fed thinks about it is when you get these big headline numbers on inflation, if they don't respond, then people will begin to expect it, and it will become a self-fulfilling prophecy. And that's what they're trying to avoid. Whether they're do too much or not is a matter of judgment. I'm glad that I don't have to make those calls. I don't think they've gotten to the close call point yet. When you start at zero, it's not that hard to say we're going to get rates up. We got 40-year lows on unemployment and 40-year highs on inflation. You don't need to have a PhD in economics to know that you got to move interest rates up from zero. But at some point, they're going to get to a level where it's going to be a really close call. And I think that's what's going to be really interesting, in part because of the reasons you said, Richard, is, as this often said, I don't know if it was Milton Friedman or somebody else, the lags in monetary policy are long and variable. Unfortunately, they have to decide what to do now without being sure what the effect will be in the future. And that's before you get to all the questions of, do we get good luck or bad luck? Does Ukraine get resolved? Is the weather better so we get better harvests? Does GM and Ford and Chrysler figure out how to get chips? Does China stop locking down its factories and we can get on with producing stuff there? So there are a lot of wild cards, and a lot of this has to do with luck. We had a lot of bad luck last year. I'm hoping that we'll have better luck this year.
Is there a period in our history that you can recall where prices really came down, that we can look back to and say this actually happened? That, I mean, wages don't tend to come down once they go up. So
well, there are plenty of times in history when we had deflation, but I don't think we want to go back to the 1920s or the 1890s. But remember, some of the prices in the inflation is an average of all the prices and things that people buy. And some prices do go up and down. So do I expect used car prices to be lower a year from now than they are today? Yes. Do I think there's a chance that new car prices might come down? Maybe. They have huge demand and not much supply. So things do, individual prices of food and oil, gasoline is down a lot in the last 6 months. So some prices will fall. Do I think we're going to go to minus inflation over the next decade? No, and I hope not. But do I think that 3 years from now we'll be somewhere in the 2 to 3% range? Yes, because I think the Fed will do whatever it takes to get us there.
You know, and if I could just add real quick, Richard, so to sort of tail off of David's point, the price level, the whole price level, that's the thing, right? So prices can go up and down, that's going to happen. But what we're worried about is where the price level itself is going to go. And throughout most of the post-war period, it's gone up slowly. And I don't think we should be thinking of, and I sure hope the Fed's not thinking of, trying to get the price level back to where it was. It doesn't have to go there. You know, so people shouldn't think of it that way. The month-to-month rate is flattened out over the last 2 months. So this, I'd say the CPI, if it continues to do that through, I think, till about maybe like March, then the year-to-year rates get back to about 2 or 3%. And then you're done. And the Fed's going to get credit for that no matter what happens, or no matter how it happened. But so you don't have to drive the price level back to the pre-pandemic level to get that inflation, to get that average and that expectation there. So the job is not necessarily as bad as we might think.
Can I just add one thing quickly? I don't want to crowd out Lisa here, the talking men problem. What really matters to people is their real incomes going up? And that's what we have to get back to. And so if people's wages are going up enough to compensate for increases in prices, we have rising living standards. That's the goal. That's where we were before. I think we'll get back to that. And that's much more important than anything else, I think.
Yeah. So jump in, Lisa. What do you think about all this? I think, you sound, I mean, you're optimistic. So I think.
I am optimistic, and I'm doing, I think, some of the same, math as Norbert, and I do think we get there by rate of change math. That being said, I think where the there is where we might disagree. We lived in a world for 13 years that was spectacular for financial markets. Because inflation averaged below the Fed target 2% of 1.7%. That meant that rates could be really low, so price multiples on stocks could be really high, and the only way you get very low yields is if the price of bonds goes up very high. So we've gone through that period. I do not think is going to be replicated. The single biggest cause of that in my mind, although a lot of people will argue with me and talk to me about globalization and technology and things of that nature. I think the fundamental reason that we had below average inflation during the past 13 years is we were going through a massive simultaneous deleveraging cycle where we were recapitalizing the banking system, the United States banking system, at the same exact time we were recapitalizing household balance sheets from mortgage debt. That leaves us in a very different position coming into this crisis. And that is that the United States private sector, whether you look at households, you look at the banking system, or you look at the corporate sector, are in spectacular shape in terms of balance sheet health. And corporates in particular have a ton of cash relative to their net worth on the balance sheet. And they've termed out their debt at historically low costs of capital. They locked it all in. So they are not experiencing the pain of the current rise in rates. Now you put that together, you put those very strong balance sheets together with the structurally strong labor market, and we can get more into why I think it's structurally strong, and this capital spending, and we think inflation ends up higher. Now overlay on all of that some of the other trends. We think the world is deglobalizing, right? We think that there's evidence that both through government programs and political will, there is a desire to reshore American jobs. That is ultimately probably going to be a good thing with regard to supply chain security, but it may be a bad thing with regard to the rate of inflation. I think, we want to rethink our commitments around how to achieve cleaner energy. And I think that path towards decarbonization, if you will, is going to, continue to be fraught. And that path to decarbonization is probably going to put upward pressure on prices, especially if geopolitical blocks are, realigned, as I fundamentally believe they are. A third issue has to do with the United States dollar. The US consumer over the past, several years has benefited extraordinarily from the speed with which and the differentiation with which the Fed has moved. As a result, the United States dollar today is at multi-decade highs against many of our major trading partners. I mean, we're talking about a pound sterling that was not this weak since 1985. We're talking about a Japanese yen that was not this weak since 1997, right? We're talking about a euro that is back at parity, 2002. These are huge imbalances that have been deflationary. Even with 8.3% inflation, our imports are not inflating at that rate because of the purchasing power of the United States dollar. If for whatever series of reasons, other central banks around the world catch up to the Fed and the United States dollar starts weakening in a secular move after what has been what we think a secular appreciation, that will be an inflationary tailwind. So, I mean, I could keep going, but the bottom line is, we're more in the camp that says inflation is going to be 3 to 3.5 than 1.7. We're not going back to the days of Larry Summers' secular stagnation. We're just not.
But you see inflation at 3 to 3.5% over the next, say, 5 to 7 years, something like that. And
Yeah.
you think the Fed just tolerates that, or effectively maybe they don't raise the target from 2%, but they kind of never get to 2%. That's kind of what you figure.
Yes, and there's good news in this. And I know, as an investor, people don't like me talking about this. Okay. But the reality is, if Jay Powell truly is a central banker at heart, as opposed to a private equity executive, then he will do the right thing and try to press, right, that Fed funds rate up as high as he possibly can without crashing the economy. Why? Because he knows that running an economy with negative real interest rates for prolonged periods of time, right, is a dangerous, dangerous game of poor capital allocation. And he knows that an economy in the long run operates much better, much, much better when you can have a 10-year treasury at 6%, right? So fixed income bond investors actually earn a real return, right? He knows that that's a more stable, more sustainable economy. And so, yes, do people in financial markets cheer for the Fed to be done? Yes, they do. I do not. And that's basically because I got kids and I want the United States economy to not become Japan.
This is really interesting because I think I agree with your endpoint, but I probably get there slightly differently. But so I would tell the story that a lot of the forces you describe are why we think real interest rates will be higher than they have been. Real interest rates have been coming down for, I don't know, it depends what you can pick your favorite chart, but for quite a while.
Yep.
And some of the forces that are doing this, Bernanke called it a global savings glut, have to do with some of the things that you said. And we have reason to believe we're on the cusp of a period with very big investment and demographics, all pushing in the favor of the neutral interest rate, the one that's neither stimulating or depressing the economy. So I think what you're describing is a world of higher neutral interest rates. And I 100% agree with you that the Fed wants to get real interest rates now up for a lot of the reasons you said, and that they will not raise them enough to they won't kill us to get to 2%.
Correct.
I don't know how they're going to do it. They're never going to say it now because it looks like you're moving the goalposts in the middle of the game. But when we get to 2025 and inflation is 3.1, they're going to talk about average inflation targeting over the life of your grandchildren, and we can relax. So it's really interesting to hear what you say. And I'm just so fascinated by the fact that if you gave me your endpoint, I would get to the same point, but I think I might get there for different stages. So I guess that's a good thing.
So where do you guys put into your thinking the housing market? Because as we know, housing drives a lot of this economy, and from a structural problem of the supply chain to just demand dropping and mortgage rates going up, and it's such an important part about our economy. Where does it fit into your thinking?
I mean, I'll jump in first and just say, look, we're incredibly constructive over the intermediate term for housing. From where we sit, and as has been said, the demographics are starting to get extraordinarily constructive here. We need to remember, everyone wants to talk about how the world is aging and the United States population is getting older and older. That is a true statement. What is not a true statement is that our workforce is actually going to get younger and younger and younger for the next 14 years. It's the first time that has occurred in about 15 years. And that's a really good thing, because a younger and younger workforce suggests more household formation, more savings, more investment in real estate and housing and durables and all the things that go with it. So, we're in the camp that says you've got a structural longer term imbalance between housing requirements and housing supply. It may need to work itself out through the typical boom busts of real estate cycles, where multifamily picks up the slack for some period of time. We see, people do, opt for apartmental renting in multifamily settings as opposed to single family home sales. But in aggregate, we think this is going to be an above average housing recession, if you will.
Well, if you're bullish because of demographics, bullish on.
So I would say I agree with. I think it's interesting what Lisa said. So I think, look, the short term hit, housing is going to take a hit in the short term. Mortgage rates go from 3% to 6%. Not as many people are going to buy houses, and not as many houses are going to be built, and we already see that in the permits. But I think what's really interesting about the demand for housing is, and this is not financial, we're now seeing resistance to some of these zoning laws and NIMBYism that have constrained housing supply. And I live in DC, and in Montgomery County, Maryland, there's really this really interesting coalition between young millennials with money who want to buy a house and developers who are frustrated at the sort of anti-developer regime that some of the city council has taken. So I think that Lisa's absolutely right. We have a shortage of housing. There's going to be demand for it. To the extent that there are regulatory constraints, the politics are going to eventually push them away, even in California. But I think in the near term, housing will take a hit because the Fed works through interest rate sensitive sectors, and housing is one such sector.
Let's move to talking about the Fed just for a minute. So Norbert, take us.
We've been talking about anything else, Richard?
But I want to understand whether, if the Fed's got an uphill fight against fiscal policy. I mean, the Fed's moving in one direction, and the Washington seems to be going in the opposite direction. How is this going to work?
Yeah, no, I mean, at this point right now, you'd have to say that they are working against each other. Yeah, I mean, you have the much larger stimulus. I think, and again, at the beginning of the pandemic, I think they're working together in the right way, trying to prevent a major collapse. I don't fault anybody for what they did. At this stage, you can look back and say, all right, well, why didn't Congress stop with the multi-trillion-dollar spending packages? So yeah, that was happening as inflation was taking off. I think you have a good case that those are monetary and fiscal policy working against each other. So to some extent, yeah, the Fed is having to deal with that and clean that up. But I don't know, I mean, other than the size and the causes of this particular instance, I don't know that they don't work against each other on a somewhat regular basis as it is. So, but yeah,
not a big deal.
I don't agree with that. If you look at, we have a measure called the Hutchins Fiscal Impact Measure, and we look at the effect of state, local, and federal fiscal policy, taxes and spending on GDP growth. And you can see that it was a big plus during the pandemic, and it's come down. A lot of the COVID era things have worn off. Yes, Congress has passed some big dollar bills, spending bills, but those are spread out over a long period of time. So I'd say right now, fiscal and monetary policy are both in the contractionary thing. I think what's going to be interesting is what happens if Lisa's wrong and we get a recession next year. Then will Congress say, oh, it was really popular to send everybody a check, we're going to do that again? Or will they A, come to their senses and not do that, or B, be so paralyzed that they can't do anything and that'll have the same effect?
So do you think the student loan forgiveness is a good idea?
Do I? I don't, particularly the way it's packaged. I think it will add some to inflation, but not very much. I'm particularly worried. I understand the politics of forgiving some student loans, and I'm in favor of targeted student loan relief. I don't think this is as well targeted as it could be. And I'm extremely worried about the income-driven repayment plan that the president is proposing to implement next year for going forward, because I think it's not well thought out and will allow a lot of people to borrow with the expectation of not paying it back, and will tend to fuel tuition increases or in proliferation of shoddy programs, which basically just take money from people and not for any good purpose. So I understand the politics of this. I think that there are a lot of people who got screwed by the student loan system. And I think that targeted student loan relief is called for. I just wish the president had targeted a little better.
Yeah. So Lisa, how much does the stock market factor into your thinking, and then ultimately this election? Two different questions.
Yeah, those are two different questions. So let me just, be super clear about how we think about it. The market and the economy are two different things. The economy informs the market. I'm not a big believer in the other way around. Yes, there's a wealth effect. There's no doubt about it. There's a confidence sentiment effect about stock markets. But the reality is that the vast majority of spending in our country is actually not done by the people who own the bulk of assets in the stock market, and their marginal propensity of investors to actually spend incremental dollars that they receive is extraordinarily low. What tends to happen is, they just invest more and they save more. So these are two very different things. My bullish view about the economy is actually, turns out not to be massively bullish for the stock market. And the reason is that I quite agree with David. We're at a point where, corporate profits as a share of the United States GDP is at all-time high records, even with, this modest 24% pullback from January to June. Right now, from January 1st, where the S&P 500 is still down only 18%. I say only, that's not a market discounting a recession, quite the contrary. This is a market that has basically woken up to the fact that you cannot sustain 21 times forward multiples when your interest rate went from 0 to 3. That's all. We have not seen companies cut their forward earnings estimates yet. We have not. FedEx is the first. We may see more, but this is a market that has been extraordinarily resilient in the face of many, many things. We believe that valuations in the United States stock market remain unappealing, given our views about inflation and the direction of interest rates. But we do think that the U.S. economy, and for the average American or the average person who's attempting to find a job and support their family, prospects remain decent. I think investors are going to face headwinds over the next 12 months, though.
Oh, interesting. I think we should move to audience questions because we're taking up all the air here. Dale, can you manage that for us?
That I can. Although you guys have been doing a very good job of seeing the questions as they come up. The one question that a lot of people have that I don't think you've addressed very well is China. And as so many of the European big companies and other countries' big companies are cozying up to China, and we've got the difficulties with China and the US. And so it appears that the US access to low-cost, reasonable quality goods from China is going to significantly diminish, and probably the diminishment is going to increase over time. So if that is the case, or maybe if you disagree, be interested in hearing that. But if that's the case, what is the impact on longer term inflation?
I'll give this to Norbert.
Okay. Well, I hope that we don't continue down the road or the path of the last administration and make this a trade war sort of thing, because that path does have the potential to create inflationary pressures. But aside from the inflationary pressures, it's just a bad idea. It's bad policy. It doesn't give us more stuff. It gives us less stuff. It doesn't give people more opportunity across the globe. It gives us less opportunity. It's a bad idea. Nobody's going to win a trade war. And I just hope we stay as far away from that as possible. So I guess I'm a little bit agnostic. I guess it depends on who the next administration is. Although I don't think the Biden administration has fully reversed our sort of tariff and trade policy, and that hasn't necessarily been good either. So I guess I'm saying I hope we go away from that completely. Otherwise, it will, yes, that would increase inflationary pressures.
So does the Chinese economy slowing down matter to us?
Absolutely.
Yeah.
It's a pretty big economy these days.
Yeah.
Yeah, I think
you raised a lot of different things there. So one, China's a big player in the world economy. What happens in China does not stay in China. They buy a lot of commodities. They are a competitor of ours in a number of areas, and they're trying very hard to compete with us on high-tech things. There's a lot of geopolitics here going on. I think that the era of China as a low-cost producer is probably fading, but that just is good for Vietnam and and Laos and Cambodia, that already we're seeing production moving there. But Lisa said something that's really far more fundamental, which is, are we at peak globalization? Are we now the combination of wanting more resilient supply chains, national security, all the tensions between China and the US, and everybody learning a lot from the COVID recession and the supply chain thing, the pandemic? Are we going to be in an era where there's less globalization, which probably means less efficient economies, may mean more jobs in some economies or some communities? And that's basically a way of saying that we'll have slower productivity growth. And it's a trade-off. We may have more resiliency. We may not be so vulnerable to supply chains running through China, but we may have to suffer slightly slower growing living standards as a trade-off for that. And that's a possibility. I think that, like, if you could tell me one thing that I really want to know 10 or 15 years from now that would influence what I think about what the world economy is going to be like, it would almost all of it involve what's going to happen to China. Is it going to crack? Is it going to become autarkic? Are they going to reintegrate into the world economy after this episode is over? I just have no clue. And I think it really matters.
So let me just throw out another perspective, and that is that I think that the reaction of the world to the Russia-Ukraine war is very, very telling on many, many levels, and I think again is probably unprecedented in the post-World War II period, and it's unprecedented in the number of countries, I believe, who have chosen self-reliance or their self-determination over allegiance either to the United States and the NATO alliance, who may have previously been perceived as allies, or to some of the premises of UN principles. That includes countries like India. It includes much of Latin America. It includes almost all of Asia, and it includes even countries like Israel, who have continued to trade and accept rubles and business with the Russians. I think that suggests that we're in a completely different world where this concept of deglobalization may be true for the United States. The United States may be entering a period of deglobalization. It's not entirely clear to me that China and the rest of the world is entering a period of deglobalization. In fact, just this past week, there were meetings of, I think it's called the Organization of Shanghai Business, that included participants from China, from Russia, from Iran, from many, many countries who want to trade with one another. And so I think the question for Americans is, what are the economic and cost of capital implications of that? If the rest of the world decides that they are tying their fate to China, which is on its way to being the world's largest economy, as opposed to the United States, who's on its way to being the number 2 largest economy. I know that's painful. It's painful for me to say that, but I think we need to think about it.
I agree too, Lisa. I mean, it's a real danger. And it's one of the reasons that I'm constantly saying we need to step away from this trade war stuff. We need to stay engaged and involved and part of the entire global economy. Otherwise, it becomes even more dangerous to go down this path that we're talking about here. And that's not good.
So do you think we've lacked industrial policy? Is that part of our problem?
Industrial policy in the classic sense of
Protecting
government setting up programs and targets and stuff? No, I think that's
what China does.
Yeah, yes and no. I mean, that doesn't, even to the extent that they do, that doesn't mean that we should do it, and it doesn't mean that that's the the way to stay engaged and the way to trade and the way to get our standard of living up. So no, I don't think I don't think that's where we should be going. Maybe there's disagreement on that one.
Whether you think we are or not, I think we are. You know, the CHIPS Act and other things, we're taking a big step in that direction.
Yeah. I agree with that. No, I guess I'm stuck in the what should we do? But yes,
right.
David's not wrong there. Yeah.
We've let industries disappear and go to China or elsewhere, from furniture to pharmaceuticals, you name it. And I think that's really cost us. And that's the problem that we're wrestling with, which is, you know, how do you take this stuff back? And how do you protect your future when, you know, when all these special, you know, all these minerals and pharmaceuticals and
I don't know.
So
I think it's more complicated than that.
You think the future of the American economy depends on our making furniture here rather than in Southeast Asia?
No, but
I would put it differently. I think, you know, one of the things that, you know, I hear Richard saying is, you know, we as a country, once upon a time, actually invested in things that were foundational to building a competitive capitalist economy, like infrastructure and R&D. And, you know, gave, you know, tax credits for capital spending and capital investment. We've abandoned that, and there are consequences to that. And at what point does it actually really start to matter that you're a country that doesn't actually have access to semiconductors, which is the equivalent of the next century's oil?
I agree with that. I agree with that. I didn't like furniture as an example, but I 100% agree. And I think that there's been a sea change in the attitudes of the kind of even people who used to agree with Norbert are now saying, oh, maybe not. You know, I think there is, and I think also. I think this, I would add to that it's investments in human capital where we've fallen down, and that's important as well. And I think here Norbert and I will agree that what we've done, that we went through a period of where we really were hostile to immigration, particularly during the last administration, and we turned away a lot of people who would have gone to graduate school in the U.S. or people who would have been entrepreneurs. And I think that that's also a mistake. And that, so I think we are at a point where, for all the reasons Lisa said, we're doing a little soul searching about what do our priorities need to be if we want to be an economy that will provide a rising standard of living so our kids and our grandchildren will live better than we do. And some of that has to do with the kind of public investment in infrastructure and R&D and climate resilience. And yes, despite Norbert's objections, steering some government money to spur private investment, that we probably need to do it. And my sense is that the kind of the center of gravity of the politics, despite everything else that's going on in Washington, is inching in that direction. Subject, of course, to everything blowing up tomorrow, which is what usually happens around here.
It'll be interesting.
Let me interrupt a second here and say to our audience that we're at the 7 o'clock point, and the discussion has been so good. I'd like to continue this, but we'll cut it off certainly in the next 5 to 10 minutes. And so, Richard, if you could go ahead, but also I would say in somewhat of a wrap-up mode, if there are any predictions of where things are going that haven't already been stated that you and the panelists would like to comment upon, I think that would be very interesting to our audience.
Okay, who wants to have a crystal ball with regard to the whole notion of stagflation? Is it zero chance? Is it a 50% chance, Lisa? Is it where do you put that?
So I'm in the 50% chance in the near term. I think we have inflation that's higher than economic growth for a period of time, and I think it's going to feel a little tough. You know, my guess is the S&P 500 flatlines. I mean, it feels like a roller coaster over the next 12 months, but we end up in about where we are today. You know, I do think that you know, interest rates get to something with a 4 in front of it. before, reverting to something closer to 2.5, maybe something that people think is the right number, in the most recent past. But I do think we avoid an outright recession, and I do think that the Fed, by both luck and skill, gets to a place where they're going to declare victory, that they got off the zero bound, that they did it. They were late, but they did it fast, that inflation is defeated or anchored, and that they were able to do it, not saying without slowing the economy, but without crashing it into a brick wall.
Yeah. You agree with that, David?
90%. I agree with everything Lisa said. I just think there's a greater risk that the Fed will push us into recession. But I think that Lisa and I I'm going to now guess something, Lisa, you can tell me if I'm wrong. I think we're in for a rough couple of years. It's going to be a bumpy ride. But I actually I have quite a bit of confidence that we'll come out of this period and we'll be stronger economically a decade from now than we are now. That I don't think that some of this is faith in the real sense of the word faith. I can't really give you 15 factors for it, but I just think that we're going through a rough period. Our political system is very troubled. I'm quite concerned about the polarization of our society and about some of the threats to democracy. So I don't think we're without risk, but I'm confident that we'll get through this. But I think the next few years are going to be very bumpy.
So I'd be hesitant to ask this next question, but I'll ask it anyway.
This is going to ruin your life as a reporter. Never apologize for the question before you ask it, Richard.
What does the world look like if Trump's elected? And how does it change your view?
I mean, the trade stuff, the immigration stuff, that's not good. I mean, I'm maybe a little bit more optimistic than 50-50 on avoiding the recession, on inflation actually staying down. But I think if the politics go that way, regardless of the person, if the politics go that way, then that changes the equation quite a bit, and not in a good way. So
he would hurt the global balance of the economy.
Yeah, it doesn't, and it doesn't. Those things don't improve our standard of living over the long haul. They just don't, and if you asked me, would I live with a little bit of government money to R&D if we had better immigration policy and better trade policy? I'd say sure. But I mean, now we're talking about a combination of all of that, and that's not good.
It would certainly be a crazy time. How about your view of that, Lisa?
Look, I want to kind of avoid, personalities or making calls on politics. I will just say, and I think, David said it eloquently, but I'm going to be more pointed. The United States financial markets, for the most part, have completely and utterly shrugged off this idea about election denial. But the premise of our country is that votes matter and that they get counted and they are trusted. And if we are going to be in a prolonged period of time where that fact is litigated in courts every time there is an election, I think that the economic health of this country is going to go the way of our democracy. I think that we have been extraordinarily lucky that we are playing a game of fire, and we risk this fire getting out of control, and you can't put it back in the box.
Yeah, I think the same could be said with several things like disinformation and there's just trust in government. There's just some things going on that we have to fix that threaten all parts of our society, including obviously the economy is the end result of that. So I would agree with you. David, any closing comments? We'll need to.
Can't top what Lisa said. I think that should be like the closing benediction. That was so well put. And I agree with absolutely everything she said.
All right,
Okay, I'm gonna step in here.
Okay.
So before we close this out, and I thank the panel, I want to thank our webinar audience. It's been a while since we've had a webinar. We've been making up for in-person programs because of the last 2 years of COVID, where we've had so few in-person programs. So we appreciate you checking in with us. Mark your calendars. We're just in the final development stages, but we will be adding in the next week a webinar on October 13th on Ukraine. And so we hope that you'll be able to join us for that. Lisa, David, Richard, and Norbert, thank you so much for your time and your expertise. It's been a fascinating conversation, and good night to everybody.
All right, thank you.
Thank you.